analysis, study, and debate of the major global trends and their impact in Mexico, and of course, our North America region. We seek to inform society with insightful, up-to-date information, as well as to impact opinion leaders and also influence political policy. For the second year in a row, we are co-hosting, with support of our partners at Export Development Canada, EDC, and the Canadian Embassy in Mexico, a discussion panel with very distinguished guests from both of our countries. At COMEXI, we are happy to take part in these events and help to strengthen the Canadian-Mexico relationship. We have had difficult times in the past, worldwide, also in the region, difficult times since we last met here in Mexico City, but still North America prevails as one of the most dynamic trade regions in the world. As you know, during the past years, NAFTA underwent a major overhaul and transformed into the USMCA, or CUSMA, CUSMA, as is known to their Canadian friends and citizens. This was ratified just days ago by the U.S. Congress. Now it is time for the Canadian Parliament to discuss and eventually ratify the agreement. And then it will be just a matter of time and the most administrative procedures before its debut and implementation. It is in this context that today's presentation is so timely and relevant. We are very honored to have Peter Hall, Vice President and Chief Economist of EDC, who will share with us EDC's global economic forecast for 2020. We are also delighted to have Mario Correa, Chief Economist at Scotiabank, who will give us his insights on the Mexican economy for this year. And they will be moderated and followed by our very distinguished associate at COMEXI and former Undersecretary of Commerce and a very, very important opinion leader in Mexico, Luis De La Calle, an economist. They will follow by a conversation among them. And Luis is currently the Director General and founding partner of De La Calle Madrazo Mancera Associates. And as I said, he was also a member of the board at COMEXI. Thanks, Peter, Mario, and Luis, for being here. And I'm sure it will be a very rewarding morning for everyone in this room. I will ask you to please prepare short questions, since we are expecting and hopefully will have time for a few minutes of Q&A session. I want to thank Export Development Canada, EDC, especially Jorge Rabe, EDC's Chief Representative in Mexico, for trusting again COMEXI to host this event, and as well our institutional and very valued partner, the Canadian Embassy in Mexico. I want to particularly extend a warm welcome to former Canadian Ambassador, Monsieur Pierre Allary. Merci. Et merci à notre partenaire de nous faire confiance cette année. Et nous sommes ravis de vous avoir ici. Soyez tous bienvenus et bonjour. Je passe la voix à Jorge Rabe. Merci.
Thank you, Veronica, and good morning, everyone. It's fantastic to see a full house and to see a lot of familiar faces and a lot of friends that are here to not only support the Canadian presence in Mexico, but also to give us a pat on the back and say that we are doing a good job here. So, as Veronica mentioned, my name is Jorge Rabe. I'm EDC's Chief Representative in Mexico. I would like to, first of all, on behalf of the Canadian Embassy, COMEXI and EDC, welcome all of you attending our Economic Series Conference with our Chief Economist, Peter Hall, also with our friend Mario Correa and Luis De La Calle, of course. 2020 is a very important year for EDC. As some of you know, in 2019, Canada and Mexico celebrated 75 years of diplomatic relations. And EDC also celebrated 75 years of operations, since it was created in 1944 by the Parliament of Canada. This year is our 20th anniversary of operations in Mexico. Mexico was EDC's very first representation in the world. So we're very pleased to actually see that the fruit of what we actually created a number of years ago is still alive and kicking. So we will be commemorating this important event through a series of events. This is the very first of a number of events that we are planning, not only in Mexico but in Canada, to highlight the work that we have been doing here for Canadian investors and exporters. Mexico is one of the most important markets for EDC. A lot of my colleagues don't like when I say that it's the most important emerging market in the world for EDC, but it's the reality. So it's one of the markets where we see a lot of opportunities for Canadian investors. As Veronica mentioned, CUSMA has been just ratified by our American friends, and we're hoping that the Canadian Parliament will follow suit very shortly. We have a number of relationships here that we have built over the years, and we expect that those relationships will only be reinforced in the years to come. Now, over the past 20 years, EDC has developed the ability to work closely with our various partners, and that includes the Canadian Trade Commissioner Service and the Canadian provinces in Mexico, Quebec, Ontario, and Alberta. At the same time, we now have the very close relationships with partners such as CanCham, the Canadian Chamber of Commerce, whose representatives are here, of course, and COMEXI. Before I continue, I would like to acknowledge the presence of some of our very close friends. So I'd like to welcome Mesdames Brenda Wills, Geneviève Dampierre, and Stéphanie Mercure de l'Ambassade du Canada, as well as our colleagues and friends from la Délégation Générale du Québec, Madame Stéphanie Allard-Gomez, the representative of Mexico in the province of Ontario, Ms. Shannon McCarthy, and Ms. Sandra Diaz, representing the province of Alberta. Thank you for being with us today. EDC is in the unique position to open multiple markets for Canadian companies, and there are many products crossing Mexican, Canadian, and U.S. borders, and we want to be a part of that. So our message is simple. Today, more than ever, EDC is committed to creating more Canadian success stories in Mexico, especially through our strategies that lend support to Canadian investors and exporters. Now, let's get down to business. Our distinguished panel this morning, as Veronica mentioned, is composed of three heavyweights, if you allow me to call you that. Not in the Mike Tyson type of way, but in another type of way, of course, starting with our moderator, Mr. Luis De La Calle. Luis De La Calle is the General Director and Founding Partner of De La Calle, Madrazo, Mancera, a consulting firm specialized in economics, regulatory processes, and international trade issues. He has extensive academic experience and has constant presence in the media through various collaborations and interviews. Welcome, Luis. Mr. Peter Hall joined Export Development Canada in November of 2004 with over 25 years of experience in economics and economic analysis and forecasting. Peter is responsible for EDC's economic analysis, country risk assessments, and corporate research groups. He is a feature speaker commenting on the world economy and Canadian international trade issues on a regular basis. And finally, our good friend Mario Correa from Scotiabank, the most international of our banks, of our Canadian banks in the world. Mario is the chief economist of Scotiabank in Mexico. He has more than 30 years of experience analyzing Mexico's economy and has worked at the Ministry of Finance, as well as ETAM's Center for Economic Analysis and Research. He is a recognized speaker on economic issues in the media and in various forums. So I would like to invite our panelists to join us on the stage here. We'll have the presentation of our two economies, followed by commentary from our moderator. So thank you very much again for your presence, and I hope that you enjoy this fantastic event. Thank you.
Gracias.
Bueno, buenos días a todos. ¿Se escucha bien? Can you hear me all right? Monsieur l'ambassadeur Pierre Allaire, ravi de vous avoir ici. Madame la déléguée du Québec aussi. There's a lot of friends in the room. It's a pleasure for me to moderate this panel and to have speakers Peter Hall and Mario Correa, two great thinkers as to where we are going. I mean, as Jorge was saying, and also Veronica, the world is going through a difficult stage, and we should see North America this as an opportunity. The difficulties everywhere happening around the world give North America a significant chance to be a more important player. Demographics, energy, capital, innovation are on our side. The geopolitical context as well. So it is for us to grab this and to take advantage of the newly renovated North American Free Trade Agreement, the USMCA, that gives us a new framework to work together and have a dispute resolution system that is now unique because dispute resolution systems in other arrangements are not working. So let's see how we can take advantage of that and change an environment where most people think that this is not a time to invest into one which we urge people to actually do it because the success of tomorrow will depend on the investments we do today. So we are going to hear first from Peter and then from Mario. They have 30 minutes allotted to them. I'll make sure that you don't go beyond 30 minutes. And even if you can make it even shorter, better, so that we can have I'll ask you some questions and then we open up for questions from the audience. So Peter, why don't you begin with your presentation and then we'll take it from there.
Thank you very much, Luis. It is a great pleasure for me to be back here again. Veronica, thank you very much for the kind welcome today. And Jorge, for your words as well. EDC is very happy, together with our embassy, to work together with COMEXI to have events like this. And so we're very grateful to have your presence here today and to be able to share our insights with you. And I'm delighted to be working together with Luis and Mario as well. For many years, Mario and I have traded thoughts at this event, and so it's nice to be able to do that again. It's also a little bit daunting to do it again because, of course, those of you who have been coming here for a number of years remember what we said. And you can now hold us to account for all of those things that we have said. I'm actually going to be as honest with you as I can this morning about some of the things that I have said and how those things might have changed now and some of the things that are actually in place at this point in time. I think we would all agree around the table that we can have a structure in place like USMCA, and I gather we are all very relieved that we actually have a deal because there was some concern about whether we would have a deal or not. And so having that in place is a great relief. There are some changes, of course, that we will have to get used to. But there's not much good having a deal like that in place if we don't have growth in the world economy to take advantage of. It's not much use if we have a deal in place, but we don't have a political framework or political structures that are sympathetic with the aims of having a deal like that in place. And so I think the first place we need to examine at the moment is what is the state of the world economy and where do we actually see it going? If we don't have the growth there, as I've already said, then there's really not much to talk about. There's a very different reaction that we would have to our current circumstances. So let's start with that. Where is world growth at the moment? Well, I like to appeal today to growth being necessary as an engine of investment. And really what's at risk more than anything else in our world at the moment, I believe, is business investment. And so I've entitled my presentation, Investment in a Hesitant World. Well, that sounds like a more gloomy title than I've ever used at these events before. And a few of you have said in the room, you're always optimistic, so are you going to help us out this morning? Well, no guarantees, because I pledge to be realistic. I want to tell you the truth about what is actually going out there. And if that truth is a negative one, that's the message I'll give you. If the truth is neutral, I will give you neutral. If the truth is positive, that's where we'll go as well. Are we okay with that today? So what you're going to get is the truth today. Now, some people say truth, economics. Are you kidding? I'll do my best.
Fake news.
Sorry?
Fake news.
Fake news. No fake news from up here today, okay? All right, so how do we deal with this then? Let's start with growth. I like to listen to the people who are actually out there experiencing growth. I think we can learn a lot from them. And one of the groups of people that really helps us out with that are purchasing managers. And what purchasing managers around the world are telling us is not very happy right now. Green is good, red is bad. Okay? That's all you need to know about all of this. There's a lot of information up there. But when we color it in, you can see where the trends are actually going. Now, there's some green at the end of the U.S. situation there. And there might be some positive things happening. But I wouldn't put my money on that when the rest of the world is actually looking very gloomy. And when those engine economies of the world, or so-called engine economies of the world, emerging markets, have been more gloomy than the developed markets of the world for much longer. Now, why do we pay attention to what purchasing managers around the world would say? Well, unlike Mario and myself, purchasing managers actually have to get their forecasts right. If they don't get their forecasts right, no job. Now, if we get our forecasts wrong, we're probably still going to have a job. We just invent great ways of saying why we were wrong. But a purchasing manager can't, they don't have that luxury. Because if a purchasing manager is optimistic all the time, they're always ordering too much, and they have to carry that on inventory. And that comes off the bottom line of your companies. So you fire them. And if they are always pessimistic about what's going on, they're never ordering enough. So when your factory lines are running and you're trying to fulfill those orders and you don't have enough materials, you have to buy materials at the last minute at high prices. And that's costing your bottom line as well. So there's a very Darwinian element to being a purchasing manager. You have to be right. And so I pay very close attention to their forecasts, and I'm not very happy with what I see. This is a forward-looking, 6-month leading indicator of where the economy is going. And when you look at that, there's lots of cause for pessimism. So I'm not starting off on the right foot here, right? It's not a very good-looking picture. Well, I'm afraid it gets worse because there are other leading indicators out there that are not looking very happy. This is the yield curve. So the yield curve is the measure that we use here is 10-year minus 2-year yields. And when that goes negative, you're almost guaranteed to have a recession. And when that's happening on a global basis, you're likely to have a global recession. Many are looking at this and saying, well, this is not a very happy situation. We're very unhappy in Canada right now because we are actually below the zero line. Everybody else is close to it. We're actually below that line. And so this is an indicator that would suggest that we are either going to have a great slowdown or a recession going forward. Well, actual activity is not looking very happy at the moment either, because when we look at both industrial production and trade flows around the world, industrial production is very close to recession, and trade flows are already in recession. This is a global monthly indicator put out by CPB in the Netherlands, and this is very unhappy. Now, what is happy about this is that something was actually going on. As we were electing leaders that were questioning the system, in both the United Kingdom with their referendum on Brexit and with the election of Donald Trump, as politicians were being put into place that were questioning our architecture, the world economy itself, by these measures and by many other measures, was actually getting back on its feet again. After many, many years of stagnation, all of a sudden, the world economy was looking very fine. And that's the moment that we lost patience with the world economy and started to question things. And this is the fruit of that. We're actually seeing a slowdown. And our question is, well, what is actually generating that slowdown? We'll get to the answer for that in a minute. The question we need to ask ourselves is, are we due for a global recession right now? Many will look at their watches and say, well, it's been about 11 years since our last one. And so we are due for one right now. Unemployment rates are very low. Other indicators are showing that we need to have a recession. Do we actually fundamentally need to have a recession? Now, looking at one's watch and saying it's time for a recession is, and you're going to have to excuse my language here, it's a very dumb reason for a recession. There's nothing that time stamps an economy where you say, okay, well, you've now run out of time, it's now time for the next recession. You have to have fundamentals in place that would indicate a recession. One of those fundamentals is housing bubbles. And so we have to ask ourselves, okay, do we actually have housing bubbles that we can point to? Now, why do I choose that? Housing is one of the most dependable leading indicators of economic activity. So if we can look at that marketplace and say there's a bubble, there's definitely a bubble in place, then we can argue that we need to have a recession. We need to have a bursting of that bubble in the economy. Well, we know what it was in 2008. We had massive bubbles in the United States and in Western Europe, and everybody agreed that that was the case. Some said, well, we have a new normal here, a high-growth new normal, where we can sustain this elevated level of activity. And they were dead wrong, because, of course, the housing sector was one of the most dramatic drops in activity at that point in time. In the United States market, it dropped by 75%. Can you imagine? Across any industry, dropping 75%, and staying at that level for 2.5 years. It was absolute carnage. Western Europe experienced the same thing. There were manifestations of this around the world, and it was because of the size of the bubble. So where do we find ourselves now? Well, some might think, okay, well, we might not have the same size of bubble in the U.S. housing market as we had back then, but there has to be some kind of bubble. If we're this long after the last recession, surely irrational exuberance is taking over inside of the housing market. Well, the exact opposite is true. This chart shows that the 2001 to 2008 period generated a housing bubble that was more than twice the size of the annual requirement of building in the U.S. marketplace. That means that new building could have gone down to zero, stayed there for 2 years, and they would not have run out of spare houses to sell in the marketplace. Now, what this chart shows is by the exact same calculations, the United States market has a housing deficit. And what's interesting about right now is that that housing deficit is as great as the bubble was back in 2008. If that's the case, folks, then we have a very different set of fundamentals driving ourselves at the moment. What this indicates is that the U.S. economy can still grow. Now imagine if we flipped around the logic and said, if we have this kind of deficit in the U.S. housing market, housing starts could double from where they are right now, and you could run along that line for 2 years, and only then would you start to create a bubble in the U.S. economy. Well, that's pretty extraordinary because many people are not forecasting a resurgence of growth. They're forecasting things going the other way. Well, that's the first piece of exciting news that I have to share with you today. A very close second to that is the exact same phenomenon is happening in the European market. You see that Europe had a massive overage of not just residential investment, but also regular business investment. By our calculations, a huge overspend. A lot of irrational exuberance in Europe as well, fed by bank lending. Now this is less discussed. It wasn't actually as popular to talk about this back in 2008 as it was about all the evil things that the US was doing. Europe believed that they had decoupled from the United States and they were going to be able to run their own game. And it turns out they had a bigger bubble than the United States had. It took a lot longer for them to work it down, but they have been dealing with levels of investment that are far more suppressed than anybody expected. And the answer that we get out of all of this, of course, is that Europe as well has a storehouse of pent-up demand that suggests that it can grow greater than its potential rate of growth for a number of years to come. Now, has anybody in the room heard that story yet? Well, maybe you heard it from me last year because I was telling exactly the same story. And I believe that this is exactly what it is that's going on inside of the marketplace. Now, I felt a little bit like Linus. Does anybody, you know the Peanuts characters? Linus, the guy that always has the blanket over his shoulder, right? He's sticks his thumb in his mouth. And every Halloween, he goes out and he sits in the pumpkin patch. And he's waiting for the great pumpkin to show up. And I feel like I've been waiting for the great housing market recovery to show up for many, many years. And my own team gives me a hard time about all this. So I'm very proud this morning to show you this chart here, which is U.S. housing starts, which for the first time since the Great Recession have actually jumped above demographic requirements for the United States. So if we are right at all about this pent-up demand inside of the U.S. marketplace, some of the recent numbers are very encouraging. Now that spike of U.S. housing starts, I don't expect that to last. I would love it if it did. But it's the permits underneath this that are really important, because for 4 out of the last 5 months, they have been above that level, suggesting that U.S. construction is waking up. So why do I spend so much time on one little indicator? Well, I believe that policy and the way that we have run it in the world economy in the post-recession period of time, whether it's fiscal policy or extraordinary monetary policy, has distorted some of our financial market key leading indicators. They're not working right now. And so they are messed up by the ups and downs of the economy and the difficulty that we are having unwinding some of those policies in the marketplace. This is one that's anchored to the real economy, and I'm putting a lot of weight on this one right now because it is talking to that underlying fundamental in the economy. So if this is finally recovering, late stage recovering, and it's a leading indicator of economic activity, and it can sustain double-digit growth over the next couple of years, folks, there is a lot of other activity that will follow in the slipstream of this activity that suggests that our underlying growth is actually much stronger. And so that now we have a problem, right? I've told you two things. I've told you that the world economy is slowing, and I've told you that in 50% of the world at least, we have strong pent-up demand. That's a problem, isn't it? I'm sounding like a two-handed economist. On the one hand, we have slow growth. On the other hand, growth fundamentals are strong. So what do we do about this? Well, have a nice day, go and figure it out, right? No, that's not useful to anybody. How do we actually reconcile all of that? Well, we need to think about how growth is changing. Now, this slide was supposed to be animated, so it's lost all of its effect right now, because you can now see what I'm going to unpack here. But what I'm very concerned about is that what we see in large nations of the world is a drop in investment activity. That's year-to-date activity in the United States economy. Business investment is in outright contraction mode. Also in the United States, trade is not doing well. Exports are down. That's partly because of tariffs. We see Germany, a huge global trading economy, one of the best at it. Business investment dropping, international trade activity down. Now in France, with all due respect to France, sometimes they do things and we're not quite sure why. So they're increasing business investment here, but it's volatile. International trade activity is still down. Canada, our business investment is up and down. So it's very, very volatile right now, and the same is true for our trade activity. In Mexico here, terrible trouble with business investment at the moment. International trade still seeming to do okay for the moment. I don't put a lot of weight into the current performance there. So that's it for business investment and for trade. Not looking happy globally in both of those. But look at the blue chart there, the blue bar. That's consumer spending. Now folks, consumer spending is about 60% of most economies out there. It's quite a large share of Mexican GDP. It's 70% of GDP in the top economy of the world, the United States, that place that we're selling most of our stuff to. Look at what's happening here. In spite of all the turmoil that's happening around the world, the bulk of the economy is still growing very strongly. The consumer sector, with low unemployment rates, with high rates of labor force engagement, is actually doing very well. So again, I feel like the two-handed economist. On the one hand, investment and trade are not doing well, and that's leading to the global slowdown, but the consumer sector, in spite of it all, seems to be riding high over all of this. So how do we reconcile these differences inside of the economy? We know, I'm pretty sure that Mario would agree with me on this. When we point at this chart here, him, two-handed economist, this chart over here, right? This, folks, is totally backwards to the way it usually happens. How does a recession normally occur? Well, one of the first places a recession occurs is in the housing market. The housing market tumbles. And for most people on the planet, the house that they own is their greatest investment. So when the value of their greatest investment plunges, or if they need to move and now the price they're going to get for selling their house plunges, if it's way lower than they thought it was going to be, their wealth has taken a hit, and that washes over into the consumer sector. The consumer slows down, businesses have a hard time catching up with that, inventories rise, industrial production pulls back, international trade then pulls back, and so there's a sequence, right? It's housing, consumption, production, trade. That's normally how an economy slows down. And then maybe 2 or 3 years later, investment drops. There's a lag in investment. Why? Because investment projects are not put into place in a day. If you want to build a new factory, it's a long process until you actually open the door and cut the ribbon. It's years. And you don't just shut that activity down tomorrow when the economy goes sour. Investment does not respond very quickly. In a time of crisis, investment can respond quickly. And that's what I would allege is going on right now. But it's completely backwards to how an economy normally falls. That's why I look at this economy and say, this is a false drop. This is led by something other than fundamental economic activity. So we need to ask ourselves, what is actually leading to this drop in activity? Well, look at all the uncertainty that we see in our world right now. Does that make sense to you that we are so uncertain at the moment? It doesn't make sense to me, because when employment growth is high, when unemployment rates are low, when wage growth starts to pick up, people are generally happy. In fact, they're too busy making money to go out and protest or to be unhappy about things. So why then, at what some are calling the peak of the cycle, the best times that we have actually had as consumers since the Great Recession itself, why so much uncertainty? Why so much worry out there? Well, look, in the United States, this is how worried they were in the Great Recession. This is how worried they were when stimulus started to falter. This is how worried they were with the election of Donald Trump. Yes, there was a lot of policy uncertainty around that time, but nothing is as high as the uncertainty that they're actually feeling now. That's very disturbing. Well, the U.S. is just part of a great global story where this is what is happening with global uncertainty. And folks, when we see something like this, where this is relatively tame over time, and all of a sudden you have an exponential increase in uncertainty, you're going to have repercussions for that uncertainty. It's only been rising since early 2016, but investment is already shutting down as a result of that. Trade is shutting down. Consumers don't seem to be reacting. They're oblivious to what's going on. But this is what we are facing out there. China is one of the big drivers of this uncertainty out there. Yes, even China, with its spectacular growth and everything that is happening in the dynamism of that economy, they weren't very worried when the Great Recession came. They weren't very worried with the peak of stimulus. They had lots of money. They were able to spend their way out of things. They were quite a bit more worried with the U.S. election, but even that calmed down for a little while afterwards. But now with the imposition of policy, there is no place on the planet that is more uncertain than China. Nobody else is rising as exponentially as China's fear factor at the moment. I think that's very instructive for us in where we're going. How do we actually telegraph the rise of this uncertainty, or its sister, populism, inside of the marketplace? Now, those of you who were at my presentation last year saw exactly the same chart. This was a study that was put together by The Guardian in the UK, European economies. What's disturbing about that is it doesn't matter whether you are on the left wing or the right wing of politics, or whether you're right down the middle. Everybody's populism is rising. We've got an uncertainty factor, a discontent factor that's happening around the world that cuts right across the political spectrum. And this is very disturbing. Now, the second chart that I put in there was to illustrate, if we really roll back over time, global populism now, how does it compare to periods in the past? Well, this was done by Bridgewater by clipping newspapers back to 1900. And they found through the verbiage of newspapers that there was no rise in discontent or populism around the world that matches anything like the Great Depression, except where we are right now. And this is very troublesome, because if the world is as populist as this, and as uncertain about where policy is actually going, then we've all got a great big problem. This is a very messy chart, and this is why it was supposed to be animated, but isn't. So I am going to have a hard time explaining to you what's going on here, so I need your attention. The first line we want to see is this line here, the yellow line. That's the U.S. unemployment rate. That's normally a measure of satisfaction inside of an economy. Remember, what we're trying to answer here is, why is all this populism with us at the moment? So what you can see inside of this red line and the blue line that's underneath it is that when the unemployment rate in the United States was coming down, so was the rate of labor force participation. And that shouldn't happen. When an unemployment rate comes down, it means that the labor force is tightening up and more people are actually getting engaged in the economy. So something was seriously wrong with this picture. The unemployment rate's coming down, more people are leaving the labor force. That doesn't make sense. This went on for 8 years, folks. And what this means, when these numbers were coming down, even the older workers in the economy, when that rate of engagement was falling, we were saying to people that lost their jobs in the Great Recession, don't worry, it's only going to take 8 years for you to get your next meaningful job. Do you know what we were saying to new university grads at that time? They weren't getting their first meaningful job, and we were telling them they had to wait anywhere from 5 to 8 years to get their first meaningful job. Can you imagine going through your educational program, having all of this student debt that's associated with that, and somebody coming along and saying, yeah, just wait 5 to 8 years, and you'll be fine after that? Well, over time, the group of people that were left aside by the lack of economic growth grew to be significant enough to change elections. This is true in the United States. It's true in Western Europe. It was true of the Arab Spring, which saw all of this happen very instantly, that cascaded across that region of the world with some of the most resilient political structures. and they fell in days as a result of this phenomenon. So one by one, countries around the world have experienced this phenomenon, and it's why we have a wave of protest movements around the world. Because over this period of time, we have not had answers to this problem. So here we are, we're caught. We are caught in this continuum here, where populism, rising out of the discontent of this labor situation, has given rise to politicians who have put policies into place. And we've been putting policies into place to remedy this for long enough. Those policies haven't worked, and they have fed the growth in populism around the world. Well, that's the context for where we are in right now. And so we ask ourselves, who would invest into a marketplace like this? No wonder investment is holding back, because we've got policy experimentation happening around the world. Why is that? Well, the populists are so fed up with our system right now that they don't believe in political parties, politics, or politicians. They don't believe in multinational enterprises because they haven't provided an answer for this. They despise the 1% because they are benefiting from this at the expense of everybody else, so they think. They do not like post-war institutions. So they don't care if we interrupt that apparatus, if we start disintegrating those systems around the world. And they are certainly not friends of globalization. Well, that's a terrible situation to be in, when about half of the population is actually feeling that way. So again, who would invest into an environment like this? Well, we have to back away from this and say, what then is the game plan? What are the people in power actually conceiving of inside of all of this? Well, this is where the argument can go a number of different ways. But I'm going to take a particular point of view that you may well disagree with. I actually am one of those rare people who believes that there is method behind the madness of policy making, particularly on the international trade front at the moment. Now, before I lose you, let's just think about what's happened over the last little while. And here's where I have bragging rights, I think, because I came here in 2017. Who was in my presentation in 2017? You don't remember. Okay, well, you were here. Do you remember my little prop that I had in that presentation there? Anybody remember what I pulled out of my pocket? I had a purple thing that I was carrying around. Anybody remember what that was?
Yes.
It was a necktie.
Trump.
The Trump tie. Okay, this guy gets a prize. I turned that tie around, and yes, it says Donald J. Trump on the label on the inside. What did I do then? I turned it around to the tiny little part at the end of the tie that says made in. And where did it? It got made in China. This was a moment of realization for all of us, wasn't it? Because we realized that here's somebody who claims to be against globalization who is benefiting from it. And then we talked about Steve Mnuchin and what he knew about global supply chains. We talked about Rex Tillerson, who at the time, Secretary of State, big guy inside of ExxonMobil. Give me a break. Like, he doesn't know about global supply chains? Of course he does. And then wily old Wilbur Ross, who is also benefiting from trade with China, in spite of everything that he says. And so I made a bold prediction at that time, didn't I? Anybody remember my prediction? I said, relax. You are going to have a free trade deal. And that's when the eggs started getting thrown at me. Remember that? Because we didn't think that that was possible. Carrier was under extreme pressure to stay in the United States. Ford was talked into changing their Mexican investment plans. And I was down in Querétaro facing an audience there where Magna had just laid off 50 people. They were traumatized. I'm not sure if there's a word for layoff in Mexico here. But that's how traumatized they were, and I was saying, relax, you're going to get a deal. I thought I was going to get murdered, actually, but we've got our deal. So what's the logic that is driving all of this? What is the logic that drove the argument back then? Folks, it is an economic logic that means the cost of not doing so is too high. Why did we get a decisive vote in Brexit on the week of December 9th? Economic logic. The Bank of England did an analysis that said the United Kingdom economy, if there is a no-deal Brexit, if they fall off the cliff, it will cost them 5 to 8%. The Great Recession cost the average OECD economy 4.4%. So the near side impact of Brexit going badly is worse than the Great Recession, possibly twice the impact of the Great Recession. Nobody wants to go there. No politician wants that on their epitaph. What about US-China? Well, December 9th was a great week for me because 1, 2, 3, we got significant movement on all of these things. US-China, Brexit, and of course, our free trade deal. All predictable. Okay, I think it was easy to predict that those things would happen. Why the US and China? Because, folks, again, the cost of not doing so is too punitive for a very weak Chinese economy and too punitive for a very proud US consumer who does not want to pay more for their goods and services. So, folks, this is why this has all happened. Does logic have anything to do with it? Absolutely. Logic drives these things forward. I've talked to you about our predictions that we made. I've talked to you about the week of December 9th. Is there more to do in the US-China? Yes. The tariffs have not been lowered to zero. That is the end game. I believe there's a significant likelihood of that happening within this calendar year. Brexit scenarios that we're working on, we believe that they will get a Canada-CETA-style deal with the rest of Europe. USMCA and our future, well, it's great architecture for us moving forward. It's much better than the alternative of not having a deal at all. So we in Canada are very pleased with what we have with the United States. We wish we didn't have to go through the ringer there, and I'm sure you feel the same way here. But we have these things in place. Now, what does that mean for our global outlook? What does it mean for our strategic approach to all of this? Well, it means that we act in a way that everybody else is not acting at the moment. There is still concern about where this is going to go. But we have enough evidence now that those who are in power actually want to put things back together again. They are challenging existing norms. What is the outcome of all of this? I believe the outcome is actually not a blowing up of globalization, it's a strengthening of globalization. Did you see what happened with the USMCA deal? In Washington, they were quickly gluing back together the pages of the Trans-Pacific Partnership and borrowing technology from a next-generation deal and putting it into one of the original deals and upgrading it, modernizing it, making it better, putting provisions in there on trade and services, trade and intellectual property, and so forth. Things that I believe are strengthening globalization overall, things that are moving us forward. It's the exact opposite of what many people think is actually going on. What about the compact between the United Kingdom and Western Europe? Well, everybody would agree that it has its weaknesses. And I believe that what the UK is trying to do is to strengthen that relationship, to fix some of those things that weren't thought about originally, and to strengthen that as time goes forward. And I believe that's exactly what is happening between the US and China. The US has been bitter against China since they got their free pass into the WTO back in 2000. The US feels the trade table has been tilted, and many other OECD nations agree. Notice how silent they are about what the US is doing with respect to China at the moment. There's no acrimony from them at the moment about what's going on. I think they're sitting on the sidelines and saying, good on you. You know, if you can actually get this playing field more level, then trade globally will be strengthened. This will be a world in which China can prosper and the rest of the world can prosper at the same time too. So that's the optimism inside of this speech. What does it mean for us as we carry on our activities? Well, this world is a world about getting investment right, as far as I'm concerned. That's the piece of gross domestic product right now that's the weakest. And so if we can conceive of a world where globalization and the institutions surrounding it are actually strengthening, then we can swim upstream from what the rest of business is doing. I've got 3 pieces of advice to leave you with. They're the same pieces of advice that I gave last year. I'm feeling even better about them this year, okay? So number 1 is, while businesses are running away from a situation that globally is very complicated, there's an opportunity to run into that vacuum and make relationships and do business because the world is fundamentally strong. This is a comparative advantage for companies that are doing it. And those who were in Querétaro when I said the same thing back in 2017 are thanking me now because they've made relationships with supply chains that they never thought they were going to get into. That's piece of advice number one. Go for the gap. Piece of advice number two is surf the surge. What do I mean by that? Well, if there's a great investment holdback that's happening in the world right now, and there's no good reason for it because growth is fundamentally strong, then it's like stopping up a fast-flowing river. You know what happens there? You better have a very big wall to hold back that water. And of course, all of this uncertainty is a very big wall out there that's holding that water back. When it dawns on everybody that globalization is being strengthened, that wall is going to break, and guess what happens? The investment money flows back into the world economy. And I want you all, and I want all Canadians to understand that as we're doing business together, we better prepare ourselves for that wall of water coming into the world economy. Final piece of advice is dare to diversify. We Canadians are not necessarily very good at that, but that is where the growth is going to be going forward. Well, you have your own special challenges here with respect to investment in Mexico, and that makes the picture difficult. And I'm going to let Mario talk about that, and I think we're going to talk about it around the table here and share our thoughts on that. So thank you for your kind attention and for considering at least the zany view of the world. Thank you.
Thank you, Peter, for this very thought-provoking presentation, an optimistic one, by the way. Thanks for sending an optimistic message as to why we should be investing and diversifying today before the wall breaks and there is a flood of investment going on. Why don't you, Mario, give us a perspective from Mexico, and then we have a discussion ourselves.
Well, can we put the presentation, please? Once again, it's a real pleasure to be here with you. I'm very excited. It's the same. And I hope it's not PDF. There it is. Well, once again, it's a real pleasure to be here. I'm very excited to share some thoughts about what's happening with mainly the Mexican economy. Perhaps just before going to the slides, I'd like to make a couple of observations here. The first one is that somebody told me that the crystal ball that you can see there, trying to present the outlook for the future, it appears to be upside down. It's just a coincidence. Please don't think it's on purpose. And now another thing I want to clarify before I start. I like to talk as an analyst. I'm talking here what I see about the Mexican economy. This does not necessarily represent the opinion or the stance of the institution I work with. So let's start. And I like to start with a quote by one of the best writers I've read, is Mr. Mark Twain. And he used to say that you cannot depend on your eyes when your imagination is out of focus. And I guess that it's very important in this particular time that we are living in. And let me start with a comment about what's happening now in the economy. And perhaps we can see a couple of different things. On the one hand, we have the financial situation, financial markets, a lot of optimism there. Financial markets are performing relatively well. Our exchange rate is surprisingly low, and we are perceiving that kind of thing happening globally. And perhaps I guess it's a good idea to start with this. And I like this graph. You can see here an average of the 10 stock markets. It's a simple average of the main stock markets in the world, from the S&P, NASDAQ, etc. And you can see the roller coaster that we have been experiencing since the last year, 2018 and then 19. And in 2019, there was a surprising increase of more than 23% in the value of stocks. On average, that means that some stock markets gain more than 30%. And we have a lot of ups and downs in this process. And it is true that some of the factors that were representing some uncertainty and were having a toll on the financial markets behavior, get diluted, let's put it this way. All these fears of a possible confrontation between China and the US in the commercial arena, the Brexit, for us, the agreement of the new trade deal, those were factors that were producing a lot of uncertainty and were affecting financial markets. They have now gone there out of the picture, basically. But if you see these breaking points for stock markets, you can see that something happened that produced a significant change in the environment, in the perception of investors, and have to do basically with the Federal Reserve and the US monetary policy. And you are going to see, the first couple of arrows there, September 2018 and then December 2019, there were some announcements by Mr. Powell, the President of the Federal Reserve. But from September of last year up until now, in which this rally resumed, it has a lot to do with what the Fed is doing, and you can see it in this graph. The Federal Reserve, I have to clarify, Federal Reserve BS means balance sheet. Please do not think something else. They started to increase the amount of money being injected to the markets in September. And I guess it's not coincidence that markets started to grow at that particular point in time, because for financial markets, liquidity is like a drug. It feels good in markets. Money have to go somewhere, and if there's a lot of money, well, part of that money is going to flow into financial markets, and especially in stock markets. So I guess, and we should have that in mind, a lot of what's happening has to do with what the central banks are doing globally, especially the Federal Reserve. If they eventually change their policy or do something different, there are going to be consequences, and we should have that in mind. Of course, the coronavirus just made a brief appearance. You need to pay attention in this presentation so you don't miss anything. Now, just a very brief non-comment about the new trade deal that we have. Of course, we have here one of the most renowned experts, so I'm just making this non-comment, bringing you this cartoon of one of the finest cartoonists here in Mexico, Paco Calderon. That was the former NAFTA, and this is how he looks at the new USMCA, or whatever you like to call it. It seems, from this point of view, that we lost something compared to the previous deal, but I will leave it there. Now, talking about Mexico, and it's interesting because what Pierre mentioned about investment globally is happening particularly here in Mexico. We are experiencing a severe contraction of investment that you can see in this graph. In the last decade, total investment, and this is the latest figures from January to October, are falling at the deepest pace, the strongest pace, the deepest contraction in more than a decade. And if you see machinery and equipment investment particularly, it's the same thing. It doesn't usually drop, and this year is reducing. So something is happening with investment. And for the Mexican economy to start growing again, one of the main things that need to happen is that we need to observe investment growing up once again. And I guess it's time to make some comments about inflation, to share some significant data about investment. More close to 86% of total investment here in Mexico is realized by the private sector. The public sector produced only 14% of investment here. And that means that for investment to start growing again, it is the private sector, the one that needs to get their issues in order and start investing once again. And if you see this couple of next slides, if you take into account, for instance, the larger firms in Mexico, the listed firms in the stock market, this is their investment in real terms in the last years, in January, September, and it is falling. They are not really investing. And we could think that these companies are very professional in their handling of the company. And when the environment is tough or uncertain, the thing to do is be more conservative, and I guess that's what they are doing. And if you take into account that even these large firms, you sum all the investment of those firms together, they don't reach even 3% of total investment. So it is not a matter of the largest firms in Mexico to start investing again. Now, if you see the number of economic units in the country, it's kind of a number of firms, but you can think that one particular entrepreneur, it's not precisely a firm, so perhaps that is why he calls them economic units. We have close to 5.5 million economic units in Mexico. But most of them, more than 95% of them, have less than 30 employees. And that tells you that most of the employment in our country is produced, and also most of the investment in the country is realized by small to medium-sized firms. So these are the guys that need to start spending and investing again. And if you see in the different sectors of the economy, much of them are concentrated on retail trade, other services, restaurants and hotels, manufacturing. So it is the medium and small firm, the one that needs to rebound, to start investing again before Mexico starts growing again. But if we think, what could be on the minds of these investors? Why are they contracting these investments? What's on their minds? Let me share a couple of things I've learned from neurosciences, how our brain works, and we're going to conduct here some examples, some experiment, because our brains are quite interesting organisms, machines. They are very good at identifying patterns and gather knowledge, and we are going to see how that works. And let me bring you this image, and let me ask you, what do you see in this image? Some people have told me that they see a woman there, or perhaps a cat. Some of my colleagues said that they see a Phillips curve here. That's what they say. What do you see here? Well, let me help you, because this is a black and white image. It's not well defined. If I bring color to the picture, now perhaps you can see the snake around there. Have you seen it? Okay. Then what happens once again when I take the color off? Everybody is still can see. Everybody can see the snake, even though color is now away. Can you see it? Well, our brain, it's very good at recognizing these patterns, and once we have this pattern, we get the knowledge. We see what it is there. And what are the patterns being recognized by the investors in our country? But before going to that, I'd like to bring a thing that was this really shocked me. Perhaps you know Mrs. Geeta Gopinath. She is the IMF chief economist. And now that the IMF presented their global economic outlook, she presented a very small comment on their webpage. You can find it there. And she said many things, especially some recommendations to policymakers. But the astonishing thing was this, and that is the actual comment on the IMF page. To aid the recovery and growth, policymakers should do no harm. Wow, what a recommendation. And it is that don't supposed to happen all the time, where they are supposed to do the right thing. But why is this lady saying that? And I guess that it is because we are seeing a lot of policy disruptions or different kind of policy that doesn't perhaps make a lot of sense from the economic point of view, and that is having an impact on the global economy. Let me bring you a quote of Groucho Marx, a quite interesting character. He used to say, talking about politics, that politics is the art of looking for trouble, find it everywhere, diagnosing it incorrectly, and applying the wrong remedies. And that gives me a chance to talk about, I'm not if you have heard about the Cobra Effect. It's quite an interesting story because it happened in India when it was under the British government occupation. And a couple of centuries ago, there had this huge problem because a lot of people were dying, bitten by these snakes. And so the government thought that they could provide some solution to the problem if they pay for every dead cobra that the people took to them. They are going to pay some amount of money. That was the idea. Perhaps it's the first historical record of the ocurrencias, or the things that, the ideas that doesn't necessarily work. What happened there? Well, the problem continues. Many people keep dying of these snake's bite, but there were a lot of people collecting the money from the government. So when they knew that the people was breeding cobras in order to cash from the government, because it was cheaper to breed the cobras than to go hunting them in the jungle, then they understand that they did something wrong and they stopped that policy. The problem get worse because everybody let the cobras loose, and so more people die. And that is a good example of what happens in a country or in an economy when there are poor policy decisions. And once again, thinking about what the IMF is seeing and they are saying, perhaps we have a lot of that in many countries. These are some of the events that took place in 2019. There were many of them, and perhaps we have forgotten some of them, but all of these events have a huge impact on the economic performance and financial markets. And if you take into account, once again, what is the investor thinking in Mexico, the medium and small firms investor, the entrepreneurs, what are they thinking? They are in this kind of attitude, very optimistic about future sales, and they're investing in warehouses and more business developing activities, or perhaps they are more worried about all the fiscal issues, the reforms, the low sales, the costs, the insecurity problems. And I guess, looking at the data, we can think that the second kind of explanation it's more likely to be happening. How does then the 2020 year looks like? Kind of like this. But let me take out the color because otherwise you are going to think that there's some suggestion in the image. It's a problem. And you can see here, we have last week the numbers for the GDP. The GDP, as you know, is the total production of the country. It fell 0.1%. And you can see here the year-to-year growth rates since 1994. And last year there was a very small contraction, but if you take into account that the previous years, 1995, this was the tequila crisis, this was the World Trade Center crisis, and this was the Great Recession crisis, then GDP is at the weakest level in many years, without a crisis. If you see private consumption, and this is January to October, once again, since 1994, if you take out of the picture the crisis periods, private consumption is at its weakest in this period of time here in Mexico. So something is happening, something is not working, and I guess it's a good idea to start thinking what is not working and make some changes. Now the exchange rate, and you can see here the recent behavior of the exchange rate. Just let me remember for all of you that were present in the presentation last year, I've been right in the exchange rate. You remember the forecast, 95% confidence level. The exchange rate was about to end last year between 16 and 27 pesos. We hit it. For the next year, with 95% confidence, December this year, the exchange rate could be between 16 and 30 pesos per dollar. Anything could happen, but well. No, the important to have in mind here about the exchange rate and the financial environment. Remember that global financial markets are quite optimistic, in part because of what the Fed is doing, and this is also having an effect on the exchange rate. Looking to the future, the exchange rate will react to changes in global environment conditions, but also to this issue of the ratings of the sovereign debt, and especially in Pemex rate. We could experience a cut in sovereign rating grades here in Mexico, and of course Pemex is under spotlight. And if that happens, it could produce some reactions in the exchange rate. Now, talking about these ratings, you can see here the sovereign, Pemex, compared to the main rating agencies. Pemex, at least for Moody's, it's about to lose the investment grade. And if that happens this year, it is going to be the second rating agency that will downgrade Pemex. And that could mean trouble for the financial markets and our exchange rate. And the problem has to do also with the public finances and the federal government. You can see in this graph, these are the tax revenues, excluding the special fuel tax. It's mainly the income tax and the value-added tax, and it's falling dramatically in real terms. And this happens when the economy doesn't grow. This kind of taxes fail. Now that the economy is expected to grow very little, and we are going to see the forecast later, it is likely that fiscal revenues could continue be bad or not growing at the necessary rate. And that means that the government, they have a, let's say, disciplined stance of the monetary policy. But on the other hand is Pemex. And there you can see, this is the observed oil production in Pemex in the last years. Last year they didn't reach their target. This is the business plan for next year. It seems quite optimistic, and it's really uphill it's going to be very difficult for them to achieve these goals. And if you see the financial results of Pemex, this is the net profit and loss. And last year, this is up until the third quarter, January-September figures. Last year, they've been losing 176 billion pesos. And so they are entangled, both the public finances and Pemex's. If Pemex is not producing the right results, Pemex will need more help from the federal government, and that could put at stake the federal government rating from these agencies. So we need to put a close attention to these couple of issues: public finances, especially tax revenues evolution, and the Pemex's results. Now, talking about the insecurity perception in the country, you can see in this graph the number of robberies to business and how it has been growing. It has not descended yet. And if you take into account that in most cases robberies and this kind of crimes doesn't really go public, you can see here the unreported crimes to companies, in many cases more than 90%. So there's an issue of insecurity in the country. People, especially medium and small firms, businessmen, are worried because their merchandise is being robbed in the highways, and there's some crime-related activities in certain cities of the country. So that doesn't necessarily produce the best environment for investment, and that is why we're thinking it will continue to be negative. These are the main factors that are going to have an impact on the economy. Some of them are external, depending on what is going to happen with tensions. Once again, trade tensions could emerge. And internally, public policy, especially if there are going to be more changes to public policy, the issues of the insecurity, rule of law, the energy sector there, what is going to happen there, could have an impact. Especially, there's a lot of potential there to boost investment, but it doesn't seem to be the leading sector for investments, even though there's potential. This is our macroeconomic framework, the main numbers that we're expecting for this year. A growth of 1%, relatively low. Consumer, private consumption, relatively weak, 1.3%. Investment will keep falling, 1.4%. Good news, inflation is not a problem now. It will go up a little bit, but within the Banco de Mexico range. Interest rate a little bit lower. Exchange rate perhaps close to 20.50 pesos by the end of the year. So it is not a very bad scenario. It's not a catastrophe scenario. But it is a weak growth scenario, and it is likely that we will experience that kind of macroeconomic numbers in the year. That's what we are thinking. Now, we should say there's great potential in Mexico, and as Luis was mentioning, there's a huge opportunity for the North American region to get more integrated and have a better chance at competing with the rest of the world. We have a lot of the necessary ingredients for long-term growth. We have natural resources, we have a lot of energy, and especially cheap energy that will need to be exploited. A lot of labor, a young population, we have the demographic bonus there, capital, infrastructure, etc. But the problem is that for this to work, we need to cooperate better. That is what means making productivity grow again. We need to cooperate better as a country. And for this to happen, we need to have, yes, macroeconomic stability, that is one of our main assets, but we also need a strong rule of law. We also need to have strong institutions, and there's the perception that some of the institutions that we have built in the previous years are now being weakened. We need to have adequate regulation, and this is the most difficult thing to obtain, the right amount and the right focus type of regulation. We need to have productive investments. And let me tell you, right, investment, it's happening, and there are going to be a lot of opportunities for those who know where to look at. But the kind of investment that are taking place right now is those that within the firms are making firms more efficient, perhaps cutting costs. That kind of investments are needed. But new kind of investments like new warehouses for more sales, especially long-term investments, infrastructure investments that require a strong rule of law and clarity in the future, those are the kind of investments that are contained. And finally, we need to have effective markets. We need to allow our markets to function relatively well. For instance, the labor markets. We need a labor markets that it's able to take labor from those sectors that are no longer profitable or socially desirable to those that are. Imagine for an instance that Pemex, instead of producing oil, is the largest world producer of faxes. Faxes, do you know that word? Because, well, it's kind of outdated, but who produces faxes in these days? No one. What happened? The technology changed, and if you were producing faxes and you didn't change to adapt to the new situation, your company was going to get broke, and those jobs are going to get lost anyway. So you need to adapt, and to adapt to the new change in circumstances, you need to have efficient markets that work. So, by the way, one of the best advice that we give to the people is to be close to the trusted economists that you have at hand. And here in economic research, we have a lot of products. If you want, send us an email. These are my contact info, and if perhaps you can see there some of the comments. I'm now a YouTuber, now trying to be perhaps that Jew that has fled. It's kind to be recovered by this activity, but perhaps it's useful for you. And let me end. I wanted to present them. Remember with the brain that it's very good at recognizing patterns, but it needs data, it needs feedback, it needs information. And I like to bring this recommendation of this book. Those are extraordinarily good books, and we can talk a lot about them, but I wanted to make this happen. Good piece of advice: you do not need to read the whole book, just find the gold nugget there and use it, and it's good piece of advice. And let me end with this story that I guess all of you know, the story of David and Goliath. Everybody knows that story. But do you know the interpretation of an interesting writer which is called Malcolm Gladwell? It's a quite interesting subject. Let me put it this way, and please, all my respect, I understand this is Bible story. Just take, please, the argumentative, how to say, not the script of the story. No, what do we know? The Jews and the Pharisees, it's the right word. They are about to face against each other. It wants to be war, a lot of bloodshed. So the leaders decided to choose a champion. So they confronted them between them. And the winning champion decided the matter, no? And the Pharisees, Philistines, sorry for that, Philistines. Thank you for the correction. They choose Goliath. And Goliath was a guy that was like 8 feet tall, something like that. And he weighs more than 300 pounds, heavily armed. He was a consummated military guy, a soldier with a bad attitude that morning, no? That he was screaming, "Bring them to me, I will destroy them." And on the other side, by the way, who would like to take that challenge to face Goliath? Nobody? Well, that was happening with the Jews at that particular morning, until this young guy, David, appeared, and I can imagine David with this kind of millennial attitude. I will go to fight Goliath. And what happened then? Well, he was armed with just a Honda, how do you say, slingshot. Yeah. It was not a real weapon. In those times, it was not considered to be a real weapon. And what we know from the story is that the underdog, the weak guy, beat the strong guy. No? That's the story. What does Malcolm Gladwell tell us in the story? He, by the way, he wrote a book about that and explains a lot of things. But the key point is, and I'm going to show you with a kind of a movie experience. I hope that everybody here have seen the movie of Indiana Jones and the Raiders of the Lost Ark. Yes? For those who haven't, spoiler alert. Did you remember this scene when Indy is going after the bad guys who has taken the girl, and eventually in this Egypt's bazaar, eventually the crowd makes apart, and there's this guy all dressed in black with a huge sword, that he was a terrific swordsman, and there was silence in the movie, and perhaps the feeling was that, oh no, Indy's going to die. And what happened there? Indiana just looked surprised at first, and then took his pistol and boom, a bullet to the head, and end of the problem. He continued to chase the bad guys. Well, what Malcolm Gladwell told us is that the impact from a stone thrown from a slingshot, it's equivalent to a 45 caliber bullet. So this guy was armed. And the recommendation for this kind of environment, and that is to think better. What was David thinking? I know that now the economic scenario could look like we are going to face Goliath, but because it seems complicated. But depending on how we look at it and how we think. What was David thinking? He was thinking perhaps that the other guy, Goliath, was very heavy, he was very slow. The combat, if David go to a hand-to-hand combat, to close combat, he will lose. So that is not the combat that he was preparing to present. He was thinking that before this guy tries to reach me, and I can move very fast because I'm very light, I could deliver him a couple of stones, and one did the trick. So that's the recommendation for this kind of environment. We need to see how to look at things. There are going to be opportunities there for those who know how to look. And just a final disclaimer from Mr. Greenspan. I love this one. He used to say to the Congress people when he was participating in Congress, he tell them in that occasion, what I'm going to tell you today, this morning, that you have been very kind to listen to me, and that is, I guess I should warn you that if you think I was particularly clear about something, especially the political issues, then you most probably misunderstood what I say. And I could blame my poor English for that. And well, thank you very much for your attention. And well, we are now for the Q&A.
Thank you, Mario, for that presentation. How much time do we have, Jorge and Veronica? It's 10 o'clock, so we were supposed to end at 10, so maybe 10. We can do 10 minutes, so that people can leave when they please. Thanks for the presentations. I mean, we have a two-handed economist on my right hand and a clear economist on my left, which is
usual,
quite astonishing. Let me ask you first, Peter, about Mexico. You can give us your perspective from Canada as to the Mexican situation. We have, as Mario explained, and you also mentioned, a sharp drop in investment. Looking from the outside, you will say, if López Obrador's sexennial ends with fiscal accounts in order, an independent central bank, and a working USMCA, that would be classified as a huge success. He appears to be committed to those three things. Why are people not believing him in these three things and paying more attention to the snakes and the animal spirits that Mario was painting on his presentation?
Well, first of all, I need to say that my predecessor in this job is now running the central bank in Canada, and I walked into his office one day and he asked me about a particular question, and I said on the one hand, and he said, "You're fired." So I am not a two-handed economist. That made a great impression on me, and I wasn't trying to be a two-handed economist up there. I think I took a pretty solid view on things, and I'm not upset. So about this situation, I'm not just stalling for time. It's a tough question, but you know, there is data that we can go for, and there are also the anecdotes that are very important when it comes to gauging investment sentiment. And this is also very new, that the anecdotes are almost as important as the data at the moment. By the way, we in economics like to say that data is just the plural of anecdote. Data just catches up to all the anecdotes that are out there and finally tells us the truth. So, what do we see when we look out our window? If we are talking about investors in the energy sector in particular, they're not very happy about things at the moment, because when you feel you have a piece of paper that is a contract, that is something that you can depend on, and you depend on that so much that you actually put millions of dollars down on a particular investment, and something happens to destroy the stability of that piece of paper, well, there's nothing that interrupts investment, whether that's domestic or sourced investment or foreign investment coming into the country. Nothing disturbs it more than a contract that is not honored. And this is true all around the world. So clearly there is concern inside of energy investment about the lack of clarity around how contracts are going to be honored and what the process is going to be in the future. But when I flip it over to those who are investing, say, in the auto sector or in aspects of machinery and equipment manufacturing here in Mexico, they say, well, the constraints that have been placed on us by USMCA are not thresholds that are wildly destroying our business plan at this point in time. And so they're amazingly sanguine about it. So you have extremes there of points of view. Now, what is very interesting to me is when I look at survey results, I see that domestic investors, businesses of Mexican origin, are feeling more pessimistic about investing in their own country than the non-energy foreign investors, at least from Canada, the ones that I'm talking to right now. So there is a mix of views, and it all depends what sector you happen to be in. But I guess the good news inside of that is that from that standpoint, all is not lost. You don't have a wholesale bailing out of investment. You don't have capital flight actually going on. There is some hope that there is a certain type of investment that will be protected. as things go forward. And when you look at Canada's foreign direct investment record into Mexico, well, it's rising at a pace that few others can brag about.
There's a difference between Mexican investors and non-Mexican investors in the sense that a Mexican investor will have 95 to 100% of their assets in Mexico, and a Canadian investor will have at most 5% of their assets in Mexico. I mean, that might explain the different point of view, no?
It's possible, but they all have shareholders that they have to answer to. And so lost or stranded assets that are a key part of the supply chain, be they 5% or 10% or 15% of the overall business activity, can be hugely disruptive to the overall business arrangement. So shareholders do not take a light view of a stranded asset or a frustrated contract there. It's very important to them. So those who are talking to me have shareholders to answer to, and I believe that they're speaking on behalf of those. So they're not making an irrational decision when they talk about how sanguine they are about their particular investments. I believe that those are well-considered opinions.
Let me rephrase the question to you now, Mario. The premise that I mentioned was, if we end this sexennium with sound public finances, an independent central bank, and the USMCA working, investors should be happy because the future of Mexico is brilliant. Is the premise correct? Can we be confident, or are investors confident, that we'll have sound public finances by the end of this sexennium?
Well, that's a very good question, and I'd like to make a difference between different type of investors. First, the financial type of investors, the one that is going to come to the country and buy en bono or whatever other security that we have here. For them, it is very important to have this macroeconomic stability, fiscal discipline, and as independent central bank. Those are good reasons to have this kind of investments, and if you see that kind of investments in Mexico, they don't stop but even keep coming to Mexico because they are looking at this part of the picture. On the other hand, the real investor, the one that is compromising its, patrimony, its wealth here in the country, is concerned about possible changes in public policy, possible changes in the fiscal regulation, and those are taking a more cautious view to those investments. One of the important questions that we will need to address in the future is if the fiscal stance, the public finances are really strong for the long haul. Because with all these promises made, that will require money, and if the economy is not growing, where is this money come from? So right now we have a strong fiscal stance, but I guess there are many people having second thoughts about if this is going to last for the end of the sexennium. And in this kind of scenario, they are, as the people that play poker used to say, they pay for view, they call their bluff, until they see some more consistency, they will start investing once again. So I guess it's a good question. We are going to have the answer in the coming perhaps couple of years. We see a lot of building pressure on public finances, especially with falling tax revenues and with Pemex in a complicated financial situation when they could need more money, and that could be at stake, and I guess that is one of the concerns that real investors have to investing in the long term of Mexico.
Let me ask you now, Mario, a question related to Peter's presentation. He says that there is a wall containing a lot of water that once the trade tensions are removed and globalization moves forward, there will be a flood of investment. That might be probably true, but there is another wall containing excess liquidity in the markets that if it bursts, it might cause significant damages. And I was wondering whether, by listening to him, what we should be expecting now is a slowdown in the US based on something similar to what happened in 2001 and 2002 after Y2K and .com, an investment-driven recession, and not a 2009, and that the solution to the slowdown in, say, 2020 or 2021 might produce later on 2008, 2009.
Well, it's interesting question. And if you see, for instance,
So we have the two visions of these two walls, one containing future investment, the other one containing excess liquidity that might destroy markets.
Well, this wall that is preventing this water, and I interpret this as the necessities that are there, the potential that it is there, it's huge. If we start doing the right things, this region could be growing, I don't know, 2 times, 3 times what we are growing right now, from my point of view. The potential is there. So eventually, if these blocks are removed, it will flow a lot of water into the countries. But on the other hand, you mentioned all these financial issues. If you see, for instance, in the year 2000, one of the first indicators that there was some problem in the future was industrial production in the U.S. It started falling at a very fast pace, quite similar to what is happening now. No? And after that happened, and once again, monetary policy, from my point of view, had a lot of it's a big part of the explanation of what is happening in the global economy, because after that crisis in 2001, all this liquidity that was injected to the markets by the Federal Reserve produced a very low interest rate environment in which some distortions started to appear, especially in the housing market. It was, at those times, it makes a lot of sense to buy a house and for banks to grant a loan, a mortgage to buy a house. And this activity became a virtuous circle at the beginning. But then eventually, that distortion creates a lack of care by certain banks, and perhaps that was rational to do, no? If your asset is appreciating faster than your loan, and you grant a mortgage to a person that is no longer able to pay you, you still got an asset that it's worth more than at the beginning. So it's kind of a rational thing to do. But that produced the boom of the housing market in the U.S. in 2006, 7, and eventually in 2008, there was the collapse. So I guess there are still some lessons to be learned from those episodes. I do see a lot of similar things happening right now, and I hope we will learn the lesson. I'm really concerned, perhaps with the new Central Bank of Europe, when they say that they will need perhaps to use monetary policy to address other kind of problems such as climate change. And that if we start using monetary policy for every ache that we have in the economy, something is not going to work well for them.
Should we worry about liquidity, excess liquidity, Peter? I mean, nowhere to be seen in your presentation.
No. And it's not that we're not worried about it. It's the issue of absorption of excess liquidity is going to be one of the great policy problems as we move forward. We've had the luxury of operating in an environment where actual production was below our potential, significantly enough that it would keep prices at bay. And so excess liquidity was put into the system to make up for the lack of velocity of money flowing around the system. Once we get to the point where the economy reaches its potential, and I think that's still 2 or 3 years away from where we are right now, that's the moment of truth. Because as velocity of money rises, if the quantity of money that's actually out in the system remains the same, then we've got far more money in the system than we have goods and services. And so the only thing that can absorb that is runaway inflation. I don't think we are beyond runaway inflation inside of our market space at the moment. It's just the conditions that we have had over the last 11 years have not been conducive to the overuse of the extra liquidity that we have in the system. So I'm worried about that, but I'm not worried about it today. If there's a localized liquidity problem anywhere in the world, it's probably in China.
Yeah, talking about China, the David Goliath parable that Mario used, I think is very telling, because the dispute between the U.S. and China is not about deficits, in my view. It's more about technological leadership. And I mean, looking long term, the trade frictions between China and the U.S. will prove beneficial to Canada and Mexico, in the sense that we can substitute China in the U.S. market, and we can substitute the U.S. in China. And I'm not arguing in favor of trade diversion at all, but I mean, it's a fact of life that there is a need to diversify Chinese risk. And the coronavirus makes that more stark. Canada and Mexico are the best countries to diversify Chinese risk.
Not worried about it. It's the issue of absorption of excess liquidity is going to be one of the great policy problems as we move forward. We've had the luxury of operating in an environment where actual production was below our potential, significantly enough that it would keep prices at bay. And so excess liquidity was put into the system to make up for the lack of velocity of money flowing around the system. Once we get to the point where the economy reaches its potential, and I think that's still 2 or 3 years away from where we are right now, that's the moment of truth. Because as velocity of money rises, if the quantity of money that's actually out in the system remains the same, then we've got far more money in the system than we have goods and services. And so the only thing that can absorb that is runaway inflation. I don't think we are beyond runaway inflation inside of our market space at the moment. It's just the conditions that we have had over the last 11 years have not been conducive to the overuse of the extra liquidity that we have in the system. So I'm worried about that, but I'm not worried about it today. If there's a localized liquidity problem anywhere in the world, it's probably in China.
Yeah, talking about China, the David Goliath parable that Mario used, I think is very telling, because the dispute between the U.S. and China is not about deficits, in my view. It's more about technological leadership. And I mean, looking long term, the trade frictions between China and the U.S. will prove beneficial to Canada and Mexico, in the sense that we can substitute China in the U.S. market, and we can substitute the U.S. in China. And I'm not arguing in favor of trade diversion at all, but I mean, it's a fact of life that there is a need to diversify Chinese risk. And the coronavirus makes that more stark. Canada and Mexico are the best countries to diversify Chinese risk. Markets interpret the trade frictions now as negative on the peso and the Canadian loonie, but I mean, long term, the impact will be beneficial. Do you think that we should have a strategy and in Canada and Mexico as to how to take advantage of the potential structural change that we have with the Chinese economy? Because I don't think even if, as you were saying, the China-U.S. relations improve, the trade technology dispute will last maybe for the next 10, 20 years. Well, so is there an opening for the North America in that sense?
I would say if there's any opportunity inside of that, it's a very sectoral opportunity, and it's probably very closely related to 5G systems around the world. There are a few players that are jockeying for supremacy inside of that area. But the handshake on USMCA in Buenos Aires illustrated one thing to us that I think is really important, and that is you can do a deal and still have issues that are not resolved. So we had steel and aluminum and a few other things, softwood lumber in our case, that were not resolved with that handshake, and there was no guarantee given that there would be any eradication of tariffs inside of that area. So as far as anybody knew, it's a deal that doesn't deal with particular things. The need, as I see it, for tariff reduction in both the United States and in China for the preservation of economic growth, for me, at this point in time, is a separate issue to the resolution of 5G. 5G is not going to be resolved very easily. There are special interests in the U.S. and in China and, frankly, all over the world that are jockeying for position there. So I do believe that you can have a substantial enough trade agreement without resolution on that front. That is just going to take more time. And of course, it increases the uncertainty over time, because if there isn't progress on that front, then tariffs will be used as a mechanism to get people back to the table. But as I see it at the moment, what's important is the preservation of fundamental growth, policy getting out of the way of that, to make sure that we can actually have a 5G argument in a global economy that is growing. The issue for China in terms of strategizing on future growth that we cannot take our eyes off is, and Canadians love when I say this, is that Chinese middle class is growing every year by Canadian population. That's the dynamic we should be keeping our eyes on, because that group of new wealthy people inside of China growing at that rate every year is consuming more and consuming higher quality. And China itself does not have the internal capacity to meet that demand. Their net dependence on the rest of the world is growing. And in some sectors, leading sectors right now, it's growing at a double-digit pace well out to 2050. And not much in the world is growing that much. And so what we should be doing is not looking for the opportunistic gains that we can make in a world where policy can change with a tweet on the next day. We should be aiming actually at the long-term strategy. What are some of those sectors that have current strong growth that is dependable for the long-term horizon? That's really where our strategy should be. And we have much work that we can do between Canada and Mexico, industries where we have joint comparative advantage, where we could serve the Chinese market and do very well.
North America is probably the only region of the world that can feed China. The agri-industrial potential is just tremendously large. How should Mexico prepare for all this? How would you sell Mexico in terms of giving an alternative to China, in terms of investment or supplying to China, as Peter is saying? What sort of signals would you expect from the government so that we entice people to see Mexico in that light?
Well, I'm not sure what to expect from the government, but let me tell you what I think it's important to have that for a better future here in Mexico. And I agree with you. You said something the other day in an interview, that the competition with China is not going to be labor. We need to have better mental works. I don't know how to put it. We need designers, professional scientifics. We need more knowledge being developed. And we have a lot of talented people for that, but we are not aiming at that. It's a shame and amazing for me that when the rest of the world is thinking on how to take advantage of the new technologies such as quantum computing and deep data learning and stuff like that, we are thinking in going to fossil fuels. We need to start looking at the future with the things that we need. An interesting thing to have in mind, with all these monetary policy issues, the liquidity, low interest rates, the relative price of labor compared to capital has changed. And now labor is the most expensive resource. And if that is making firms to save on the most expensive resource, then you don't have a good future for jobs growth if that is just the case. If all you know how to do it's working, changing burgers in a hamburger restaurant, you are not going to do well as a worker. You need to learn more stuff, more things, and we need more education for that. And I guess that is what we should be aiming at. Because even that we could have this short-term opportunity to compete with China, providing certain amount of uneducated labor, that is not going to last, and that is going to put us behind the future.
But if I can just add to that, China is not the China of the past anymore. China doesn't actually have a growing working population, workforce population.
They lack people.
They're in decline right now. So
Young people.
back in 2000, it was 11 times cheaper to hire a Chinese worker than it was to hire a Mexican worker. Now, because of the labor constraint there, it's even. So you can compete with China on labor, and Mexico is one of 5 countries in the world that over the long term, and let's call that through 2030 for now, but even beyond that, has a growing workforce. And that is something that you can market to a world that is running out of people. So yes, the capital intensity is rising, but not fast enough to preclude the absorption of these people. So it's a top 5 country with respect to that kind of thing, and I hope I'm right in that, because I'm telling Canadian investors, hey, if you're running out of people, if you're complaining about talent, you need to look south of the Rio Grande, because there's a lot of spare labor there. And as you look at metrics on how the relative education levels are rising over time, it's extraordinary the gains that Mexico has made. So if I'm wrong on that, correct me now, because I'm broadcasting that across Canada.
But would you agree that it's uneducated labor that we need, or we need more people that know to do something? Even the people that you employ in the assembly lines, they have some particular knowledge to do that.
Okay, but
that was my point.
Let's talk about progress, though. I mean, 20 years ago, the vast majority of Mexicans in the workforce had primary education or less. And we're talking about 65%, somewhere around there. Over that period of time, those proportions have now gone to those with high school and greater education. I'm fascinated by that as a statistic. These come from, I think, the UN Development Organization.
I mean, the experience firms have in Mexico is that the operations in Mexico will have the highest productivity everywhere else, even compared to China and other places. So I mean, labor, the abundant labor is one of the comparative advantages of North America vis-a-vis China. No question about it. In the U.S. and in Mexico, and not so much in Canada. Let me just, final question for the two of you, because we have to go. Some people say that López Obrador has been saved by excess liquidity in the world markets and by high interest rates from the central bank. That the central bank has been making life easier for López Obrador and the central bank in Mexico and the U.S. Federal Reserve. The U.S. Fed by having a lot of liquidity in the market, and the central bank in Mexico by having high interest rate. If the Fed changes its policy or the central bank in Mexico lower its interest rate, then AMLO will have no choice but to announce the rounds of oil, opening up the energy sector, firing some of the people running the energy departments in Mexico, and maybe doing the Mexico City airport. Do you give any credence to the idea that López Obrador is riding on the coattails of central bankers in Washington and Mexico City?
You first.
Well, I guess my opinion is very clear on that.
Okay.
Well, I don't really think he's looking that way. I think he's trying something different.
So when we look at the global competitiveness index indicators of every country in the world, and we look at the strengths in Mexico, one of the key strengths is the policy framework. It's among the top in the world. It's what Mexico gets the highest score for. So I would have to say yes, there is a legacy there that the current government seems to be continuing inside of the marketplace, that is a vestige of stability inside of the marketplace. It seems to be something that the government does not want to violate. So the perception of that in the rest of the world is, well, first of all, since it is the key strength, it is something that everybody is watching. And so it's, I think the sensitivity of the conduct of monetary policy, the stability of the currency is fundamental to going forward in a way that is not going to cause very negative things like capital flight, either from inside of the country or repatriated investments from those are on the outside. We have not seen those kinds of movements, and I take comfort in the in the sanguine attitude of certain key Canadian investors to the Mexican marketplace right now and say that must be a part of the puzzle for them. It's very, very sensitive for them that they are actually trading in a stable policy environment. So that's what I would add to.
Yeah, I mean, I guess stability and certainty are the key for investment and regaining confidence. So with that, I think that most people have to go and work. Thanks for the honor to be with Peter and Mario. Excellent presentations and congratulations, and hoping that you will invite me next.